Did you know that 90% of investors fail to beat the market over time? Shocking, right? Yet, many people still try to time the market, chase hot stocks, or listen to the latest buzz. But here's the truth. The most successful investors aren't the ones following trends. They're the ones who understand value investing. Value investing isn't about quick gains or risky bets. It's about finding good companies at great prices and holding them for the long term. Think of it as buying a house at a discount and watching it grow in value over time. Sounds simple, but most people don't have the tools or mindset to do it right. In this video, you'll discover 6 powerful books that will change how you look at investing. These books have shaped the strategies of legendary investors like Warren Buffett and Charlie Munger. From learning how to value a stock properly to understanding the psychology of money, these strategies will give you the edge. Ready to start investing smarter? Let's dive in. Chapter 1. Unlocking the secrets of timeless investing wisdom. If you want to take your investing skills to the next level, one book you can't ignore is The Intelligent Investor by Benjamin Graham. Graham, known as the father of value investing, teaches you the art of buying stocks that are undervalued, meaning their true worth is greater than their current market price. The idea is simple: buy low, sell high, but there's much more to it than that. One of Graham's main strategies is the concept of margin of safety. This means buying stocks at a price significantly lower than their intrinsic value, offering a cushion against mistakes and market volatility. It's a strategy that stood the test of time and helped many investors, including Warren Buffett, build wealth. Buffett himself says, "The best thing that can happen to you is to buy a wonderful company at a fair price." The beauty of the intelligent investor is its ability to apply common sense to investing. For example, Graham warns against trying to time the market, something that many amateur investors often do. Instead, he stresses the importance of staying grounded and patient, emphasizing that the investor's chief problem, and even his worst enemy, is likely to be himself. You don't need to chase every hot stock. Instead, follow Graham's lead and focus on finding companies with solid fundamentals, strong earnings, and consistent cash flow. This strategy is not about getting rich quick but about steady growth over time. Another unique insight from the book is Graham's focus on Mr. Market, a metaphorical character who is highly emotional and irrational. Sometimes Mr. Market is overly optimistic, pushing stock prices too high, and other times he's too pessimistic, driving prices too low. By understanding Mr. Market's mood swings, you can buy when others are fearful and sell when others are greedy. In practice, this strategy involves developing a long-term mindset and resisting the urge to follow the crowd. Instead of getting caught up in the latest market craze, remember Graham's advice: the individual investor should act consistently as an investor and not as a speculator. Chapter 2. Beyond the numbers. How understanding psychology can boost your value investing. Investing is more than just numbers and analysis. In fact, a lot of it comes down to psychology. That's why The Psychology of Money by Morgan Housel is a game changer for value investors. It explores how emotions like fear, greed, and overconfidence can influence our financial decisions, and how understanding these psychological biases can make you a better investor. Housel says, spending money to show people how much money you have is the fastest way to have less money. This highlights an important aspect of value investing: the mindset of long-term wealth building, not instant gratification. Value investors, unlike speculative traders, resist the temptation of quick wins and instead focus on compounding their wealth over time. The book goes deeper into the concept of enough. Housel argues that knowing what enough is can prevent you from overextending and taking unnecessary risks. This aligns perfectly with Graham's principle of margin of safety. If you're comfortable with what you have, you're less likely to make impulsive decisions that could hurt your portfolio. Another key lesson from Housel is the importance of patience. He cites a powerful statistic: the average investor in a mutual fund earned 2.5% less than the fund itself. This loss wasn't due to poor fund performance but rather due to investors buying high and selling low in reaction to market swings. Value investing, however, is about having the discipline to stay the course, even when the market is turbulent. Housel also emphasizes the importance of understanding risk. While traditional finance focuses on numbers and probabilities, psychology points out that people often fear loss more than they appreciate gain. This can lead to overreaction during downturns. For value investors, This means staying calm during market dips, as these are often the times when opportunities arise. By acknowledging the role emotions play in investing, you'll be better equipped to control them and make more rational decisions. As Housel wisely notes, the hardest part of investing is not the math. It's the psychology. Chapter 3. The power of a business owner's mindset. To be a true value investor, you need to think like a business owner, not just a shareholder. Common Stocks and Uncommon Profits by Philip Fisher encourages this perspective, teaching readers to focus on the quality of the business itself, not just its stock price. Fisher's approach is all about buying businesses that you'd be proud to own long-term. He says, the stock market is filled with individuals who know the price of everything, but the value of nothing. Instead of looking for quick profits, Fisher advocates for identifying companies with strong management teams, excellent products, and consistent growth potential. One of Fisher's most famous strategies is his 15 points to evaluate a company's long-term prospects. These criteria cover everything from the company's competitive advantages to its ability to innovate and adapt. For example, Fisher advises that investors look for companies with strong research and development teams that are capable of staying ahead of competitors in terms of technology and product offerings. Thinking like an owner means focusing on the long-term prospects of the business. If you wouldn't want to own the company outright, then don't invest in its stock. This strategy encourages investors to dig deeper into a company's operations, rather than just looking at its earnings or price-to-earnings ratio. One of Fisher's key insights is the importance of understanding a company's management. Great leadership can make or break a company. Fisher advises asking questions like, do the managers have a clear vision for the future? If a company has strong leadership, that can be a good indicator that it will continue to succeed over the long run. Fisher's perspective teaches us that investing isn't just about analyzing numbers on a spreadsheet. It's about understanding the business behind the numbers. In fact, he suggests that investors should only buy stocks in businesses they would want to own forever. This long-term mindset aligns perfectly with the strategies of Benjamin Graham, creating a powerful foundation for value investors. Subscribe now. Before we continue with the next chapters, make sure to hit that subscribe button so you don't miss out on more game-changing investment strategies that will help you take control of your financial future. Chapter 4. The Art of Valuation. Mastering intrinsic value in a world of speculation. One of the core skills for any serious value investor is mastering valuation. The ability to determine a company's intrinsic value is crucial for finding undervalued stocks that others might overlook. In Security Analysis, Benjamin Graham and David Dodd dive deep into this topic, providing detailed methodologies for valuing companies. They stress the importance of focusing on a company's earnings, assets, and overall financial health, rather than getting caught up in market hype. Graham's approach is all about finding the margin of safety, which is achieved when you buy stocks at a price below their true value. If you can buy a company for less than what it's worth, you have a cushion against market downturns and potential mistakes. This strategy protects your investment even if your analysis isn't perfect. One key takeaway from Security Analysis is understanding the difference between price and value. Graham writes, price is what you pay, value is what you get. This simple yet powerful distinction reminds us that stock prices can be influenced by emotions, speculation, and short-term trends. However, the true value of a company is rooted in its fundamentals, earnings, assets, and long-term growth potential. In the Little Book of Valuation, Aswath Damodaran provides a modern take on these valuation principles, introducing a range of techniques for valuing stocks in today's market. Damodaran emphasizes the importance of understanding a company's growth prospects and risks, offering a more detailed approach to calculating intrinsic value, particularly for younger companies or startups that might not have a long financial history. For example, Damodaran's valuation method includes calculating the present value of future cash flows. He notes, valuation is the art of estimating the value of something when there is uncertainty. This approach highlights the need to account for risks and future growth, helping investors make more informed decisions. Valuing a stock doesn't have to be overly complicated, but it requires discipline. A simple formula for value investing is this: assess the company's future earnings potential, determine its growth rate, and compare it to the stock's current price. This strategy, when combined with Graham's margin of safety, offers a robust framework for identifying solid investment opportunities. Chapter 5. The Contrarian Edge. embracing market inefficiencies and taking advantage of the crowd. One of the most powerful strategies for value investors is embracing contrarian thinking. In The Most Important Thing by Howard Marks, he explains how market inefficiencies often present opportunities for those willing to go against the crowd. Marks, a highly respected investor, argues that the key to success in investing is recognizing when the market is overvaluing or undervaluing assets. He writes, "You can only be a good investor if you can understand where others are making mistakes and then take advantage of those mistakes." This contrarian approach encourages investors to do the opposite of what most people are doing, especially when emotions are high. When the market is overly optimistic, stocks tend to be overpriced, and when the market is fearful, stocks often become undervalued. This mindset is powerful because, as Marx points out, most people are too focused on the short term, reacting to the latest news and market moves. By focusing on long-term value, you can avoid the pitfalls of speculative bubbles and market crashes. The key is to stay calm and focused, even when everyone around you is panicking or celebrating. One of the best examples of contrarian investing in action is Warren Buffett, who famously said, "Be fearful when others are greedy and greedy when others are fearful." This timeless advice is rooted in the idea that the market often moves in cycles of extreme optimism and pessimism. When others are selling out of fear, that's when you should consider buying undervalued stocks. Marx also emphasizes the importance of understanding risk. While most investors chase high returns, they often overlook the potential risks associated with certain investments. He argues, the most important thing is not to lose money. By embracing a contrarian mindset and focusing on risk management, you can protect your investments and identify opportunities that others might miss. In the long run, contrarian investing can lead to significant rewards, especially when combined with value investing principles. By buying stocks that are undervalued during times of market pessimism, you can build a portfolio of high-quality companies that have long-term growth potential. Chapter 6. Future-proofing your portfolio. The next generation of value investing. Value investing is not a static strategy, it evolves with the times. As the world changes, so too should the way we invest. In recent years, there has been a growing focus on ESG, environmental, social, and governance, investing, and in the Little Book of Common Sense Investing, John Bogle emphasizes the importance of adapting to changing market trends while staying true to the core principles of value investing. Bogle's philosophy of low-cost index investing also ties into the broader trend of making smarter, more sustainable investment choices. He argues that the best way to achieve long-term success is through diversification, low fees, and a focus on quality. He writes, "The stock market is a giant distraction to the business of investing." This simple yet profound statement reminds investors to focus on the long term, avoiding short-term speculation and the noise of market fluctuations. Future-proofing your portfolio also means being aware of the rise of technology and global markets. As technology continues to reshape industries, value investors should look for companies that can adapt and thrive in a rapidly changing world. Bogle encourages investors to focus on companies with sustainable business models, strong cash flows, and competitive advantages in the marketplace. Another important factor to consider is the increasing demand for sustainable and socially responsible investments. The rise of ESG investing means that investors now have the opportunity to align their portfolios with their values. This growing trend is supported by data showing that companies with strong ESG practices often outperform their peers. In fact, a 2020 study by MSCI found that companies with high ESG scores outperformed those with low scores by 4.3% annually over a 10-year period. As we look to the future, it's also important to recognize the power of globalization. Companies that can expand their reach into international markets are often positioned for long-term growth. Value investors should seek out companies that are not only strong in their domestic markets but are also expanding globally and capturing new opportunities in emerging markets. The future of value investing will likely involve a blend of traditional value investing principles and modern strategies that incorporate technology, ESG factors, and global opportunities. By staying adaptable and forward-thinking, you can ensure your portfolio remains well-positioned for success in the years to come. Subscribe now. If you found these strategies helpful, don't forget to subscribe for more value investing tips and insights that will continue to transform your approach to building wealth.